So the end of 2022 and 2023 has been a roller coaster ride for us real estate investors and homeowners trying to buy a property. We've seen housing inventory drop off a cliff. Cost of money is very expensive and it's slowed the whole market down. Interest rates that were 3.5% are now 7.5%. This makes a huge crunch on many people's budgets, which has taken a lot of the buyers out of the market. What's going on, BP? It is James Daynard and we are back on BiggerPockets YouTube channel. And today we're going to talk about how interest rates will affect home equity and how you build this into the pro forma for 2024. In April of 2022, the Fed chair announced that they were going to start to do rate hikes to slow down the economy and slow down the labor market. And what we've seen since this announcement is an unprecedented 11 rate hikes. This has caused cost of money to nearly double or even more than double for us as investors and the consumer trying to buy that next property. The impact from these rate hikes was pretty gnarly in those first 6 to 9 months. We saw major metro markets like Seattle, Austin, San Francisco compress very rapidly, nearly 15% since those rates started increasing. Once we got through most of the bulk of the hikes and it slowed down to more quarter point hikes, we've seen the market kind of stabilized out. And by the end of 2023, our current federal funds rate is sitting right about 5.75%, which is a huge increase from where it was in 2022. So what that has done is had serious repercussions throughout our real estate market. We've seen housing inventory drop off a cliff, nearly 40% down on inventory year to date. There's not a lot of houses to buy. Cost of money is very expensive and it's slowed the whole market down. And even with rates being at all-time highs over the past 20 years, we've still seen the median home price nationally rise 3.43%, which is pretty crazy since we've seen the cost of money skyrocket. Interest rates that were 3.5% are now 7.5%. This makes a huge crunch on many people's budgets, which has taken a lot of the buyers out of the market. We saw most of the impact of these rate increases at the end of 2022 and the beginning of 2023. Every time the federal funds rate would increase the federal rate by about a half point, we would see the market compress a little bit further and further. Once the federal funds rate started going into quarter point hikes, we saw it kind of cool down and level out, even with some small growth like we just talked about with that median home price rising at the 3.4%. With these rate adjustments, we've seen the market substantially slow down. In 2021, there was over 6.12 million homes sold. Currently, at the end of 2023, we've seen transactions drop substantially since 2021, where the net volume is now at 3.79 million. That is almost 1.5 million transactions less annually. So there's a lot less velocity, a lot less movement in the market. So as we saw our rates continually increase, as investors, we started building in precautions into our pro forma. Throughout 2023, as a flipper, every property that I was purchasing, we were taking 1 to 2% off the current market value. We were using comparables that were pendings, the most active in the market. We were trying to not use sales from 3 to 6 months ago because the rates were a lot different during those times. But as the market has kind of leveled out in our underwriting, we've taken less depreciation off and we now are underwriting right at what the market's trading at today. So as these rates move, it changes the environment. We have to change with it as investors. You got to build it into your underwriting. So as we look into 2024, we're getting a lot different messaging. 2023, we were really cautious. We knew rates were going to be going up. We were factoring in higher payments on our rental properties, a little bit of depreciation in the market, because as money goes up, values could come down. Interest rates are so important for the homeowner to be able to purchase that next flip property, or their interest rates are so important for the investor that's trying to hang on to that rental property because it dictates what their cash flow is going to be. So as investors, we were preparing for the worst in 2023. The good news is now we have different signals from the Fed. Powell, in his December Fed meeting, announced that they are anticipating to do 3 quarter point drops throughout 2024. That is great news. And the reason why this is music to our ears as far as investors go is as rates start to decline, homes become more affordable. The more affordable they are, the more appreciation that you can make. So I'm going to break down what the impacts are on quarter point hikes, because as investors, we want to kind of anticipate when these hikes are coming because we can maximize a pro forma or even maximize one of our dispositions by timing the deal correctly. Now, we know that there's 3 rate cuts coming, but we don't know when. So my opinion as an investor is that we're going to see these rate cuts towards the end of 2024. And my reason being is the job market is still very healthy right now. In December, the job market added 199,000 new jobs, which is 30,000 more jobs than it was the previous month. So we're still seeing a very healthy job market. The healthier the job market, the more expensive the wages get, and it can continue to keep inflation higher. And we know that that's what the Fed is trying to battle. They're trying to get that back down. In addition to, the U.S. economy hasn't slowed down like they anticipated. In quarter 3 of 2023, the GDP saw 5.2 growth, which is much higher than they were anticipating. So as the economy doesn't cool down, that can cause inflation to kind of hang around, and they want to get that under control. That's why I think rates are going to be cut more towards the end of the year. And why is that important for me as an investor? For me, as I'm looking at deals and when I'm going into dispo, I'm going to anticipate certain growths during certain times of the market. If I think that the rates are going to go down, that can bring appreciation up, which can increase the profitability. So as I'm forecasting rates, it's going to tell me what kind of flip properties to purchase. Right now, I could look at a cosmetic flip where I could renovate it really quickly, fix it, sell it, and do it in the next 3 to 4 months. I am not going to anticipate any type of growth during that time because I think that rates are going to remain flat. That means the market could remain flat. But if I have dispos that are going out towards the end of the year, a bigger project, I might be able to anticipate a little bit of growth inside my pro forma. And that's why it's really important to track these things. So let's break down how interest rates affect the equity in a property. So for example, if you were pre-approved for a $500,000 loan and interest rates were currently at 7 when you were pre-approved. As you were looking for a home, you couldn't find what you wanted, rates rose to 8%, your new affordability amount is going to be about $450,000. That is a huge drop in your purchasing power. So that makes a huge difference on affordability when you're looking at a pro forma or as a homeowner and you're looking at the values of your home. So as investors, timing the dispo can make a big impact on your resale value and a big impact on the dollars that you're going to be selling your property for. As a flipper, I want to time my flips with the cheapest possible capital. That's going to bring more buyers into the market. Every time the rates go up, my buyer pool is going to shrink. Every time the rates go down, it's going to make higher priced properties more affordable for the masses, and my buyer pool is going to increase. So as we see rates drop, we could anticipate some appreciation in the market. And currently, there's a huge pent-up demand. In 2023, Freddie Mac estimated that there's over 3.5 million housing units short for buy or rent for the demand in the U.S. That is a massive shortfall. So as we see interest rates start to drop, the market could catapult and the demand could rip forward. Currently, with rates being at all-time highs over the last 20 years, mortgage applications are at their all-time 27-year low because buyers are just stressed out. They don't want to stay with the payments. Home pricing haven't crashed with the interest rates making their adjustments, and so it's hard to afford a property and you're getting some buyer fatigue. As interest rates start to reduce down, those applications are going to explode up. It's not that there's no buyers in the market, they are just burnt out on what the payments are. So as it gets more affordable, it's going to introduce more masses, which can force the appreciation in the market. So with the Fed announcement in December that they're going to make 3 quarter-point rate cuts, this could mean that the homes could become more affordable. As an investor, I might be able to get a little bit more growth. So let's break that down in the logic behind that. I, as an investor, don't like to gut check things. Just because I hear that rate cuts are coming, I want to make sure I'm using logic into anticipating growth. So for every quarter point, that's going to make a home about 2.5% more affordable. So let's say we have our first rate cut in July. A $500,000 house now is going to be the same payment as a $512,500 house. So there could be $12,500 in growth just on that property with no net change to the buyer that is buying now. On the second rate cut, that's going to be a 0.5 point effect on the value. So that property now that was $500,000 for that buyer can now pay $525,000 for that property and have the same payment. And on the third rate cut, that's going to make it a 7.5% affordability gain. And that buyer that that could only afford $500,000 on the house can now afford $537,500 on that property. So as investors, we're taking all the information and we're trying to make assumptions about what we're going into 2024. The great news is now we know that rates are going to start falling down instead of increasing up. Again, in 2023, we were extra conservative. We were being low on our estimated values. We were padding our budgets. We were adding more time to our timelines to account for longer sales with the lower applications. As the rates come down, there's going to be more buyers in the market. Homes are going to become more affordable at higher prices. And so if I'm looking to dispo a property and I think it's going to be the end of the year, I can feel really safe in my analytics as a flipper because the home is going to be more affordable. On this $500,000 house, someone can now pay $537,500 for this house. That could be a $37,000 profit increase on one specific deal. Imagine if you do that 10 times, that's $375,000 in profit by just timing it right. Now, I would not anticipate growth in any pro forma. As a flipper, I never put appreciation into my deal. I factor for risk. I might reduce my returns if I think the market is going to get healthier, or it might make me more aggressive in buying more properties if I think the market's going to be healthier. But stick to the same margins. If you get that rate cut, that's just upside for you as an investor. We all saw upsides when rates dropped to 2.5% to 3% in 2021. You can see the same upside in 2024 as well. This is going to bring a lot more buyers in the market that can catapult the market forward, and there could be another frenzy in 2024 and in 2025. So as you're evaluating risk for 2024, look at what's going on around you. What is going on with those interest rates? What is going on with the job markets? What's going on with the bond markets? Are they fluctuating much? Pay attention. As you see fluctuations or things get more stabilized, that could signal lower rates, which can be more appreciation. The math makes sense. As investors, don't gut check things, look at the facts. I'm breaking this down by percentages of affordability. It logically makes sense that a buyer can pay more, which is going to be more profit on your next flip. I hope you enjoyed this video on how rates will affect your equity. You have to enjoy this video. We just talked about how rates are going to go down. That's great for investors. So if you did like it, click like and subscribe below. And for more information about the market and the data, tune into the On the Market podcast or come to jamesdaner.com, or even check me out on Instagram at jdaneflips.